You are working harder than you ever have in your life, and you are no closer to financial freedom than you were 3 years ago. That is not a hustle problem. That is an asset problem. And in the next 8 minutes, I am going to fix it. If you are building a business and still trading time for money, subscribe right now. This channel exists to end that. Now, let's get into it. Here's the story most entrepreneurs have been sold. Work hard, sacrifice, scale the business, and someday, freedom arrives. That story is the trap. The entrepreneurs who actually reach financial freedom do not get there by working harder inside a single income stream. They get there by building a portfolio of assets, each one generating returns they do not require their time. The difference between an entrepreneur who is exhausted and broke at 50 and one who is free at 40 is not intelligence. It is not talent. It is not even timing. It is what they chose to build alongside the business. Here's exactly what this video delivers. By the time this ends, you will know the 7 specific assets that move entrepreneurs from time for money trading to genuine passive income. You will know the sequence to build them, and you will know which one to start with today. Not theory, not inspiration, a blueprint. This is how real financial operators build freedom, by design, not by accident. Here's how these assets are structured. We move from simple to advanced. We start with the most immediately buildable, the assets generating the most reliable and fastest cash flow. We build through equity-generating assets and compounding systems, and we end with the single most overlooked asset on this entire list, the one that determines the return on every other asset you will ever own. Each asset follows the same 6-step breakdown: what it is, why it works, how it builds freedom, the common mistake, what to do instead, and the freedom principle. Let's build.
Asset number 1, cash flow positive real estate. Property where rental income exceeds every single carrying cost: mortgage, taxes, insurance, maintenance, and management, every single month. Not someday, today. The tenant pays the mortgage builds the equity builds the net worth, and the monthly surplus builds the freedom. 3 simultaneous wealth-building mechanisms from a single asset. Every property generating $200 to $1,000 per month in net positive cash flow is moving your passive income number closer to your living expense number, without trading a single working hour for it after acquisition. And during inflation, rental income rises. Your fixed-rate mortgage payment does not. The cash flow widens automatically in your favor every year. Buying real estate that looks like an asset but functions like a liability, properties with negative cash flow, over-leveraged acquisitions, or vacation homes called investments, all of these consume working capital instead of generating it. Run the numbers before you fall in love with the property. If the monthly rental income does not exceed every carrying cost by a meaningful margin today, not in 3 years, not after appreciation, it is not an asset. It is an expense with a deed. Freedom principle. Every cash flow positive property is a permanent self-funding income stream that works whether you show up or not. Asset number 2. A business that runs without you. A business with genuine systems, trained people, and recurring revenue that generates cash flow completely independently of your daily presence. Not a business that could theoretically run without you, one that actually does. A systemized business is simultaneously the highest yielding income asset and the most valuable equity asset an entrepreneur can own. It generates monthly cash flow, and it sells for a multiple of that cash flow, typically 3 to 7 times annual earnings, when you choose to exit. It funds every other asset on this list. The cash flow from a systemized business is the capital that acquires real estate, builds the investment portfolio, and funds the digital product development. It is the engine that powers the entire freedom architecture. Believing that a busy business is a systemized business, revenue does not indicate systemization. If the business needs your daily decisions, your daily relationships, and your daily presence to function, it is not an asset, it's a job that pays well. Build systems before you need them. Document every repeatable process. Hire people who make decisions without you. Shift from doing to designing. The business you can step away from for 90 days is worth 3 to 5 times more at exit than the one that requires your daily presence. Freedom principle. A business is only an asset when it generates cash flow without consuming your time. Until then, it's a job with upside. If either the first two assets just described your exact situation, you are exactly who this channel exists for. Drop the number of the asset you're working on right now in the comments. I read every single one. Now, let's keep building. Asset number 3, dividend and interest generating portfolio. A diversified portfolio of dividend-paying stocks, government bonds, REITs, and fixed income instruments that generate regular income distributions without selling a single share, without serving a single client, and without a single working hour after initial construction. Dividend income is the purest form of passive income available to entrepreneurs. It requires no ongoing management, it generates on a schedule you did not set, and it compounds. Every dividend reinvested generates its own future dividend, creating a self-reinforcing income machine. The math is direct. A $500,000 portfolio generating an average 5% annual dividend yield produces $25,000 per year, $2,183 per month in completely passive income. At $2 million, that's $100,000 annually. The freedom crossover happens not when you have a big number. It happens when that number exceeds your monthly expenses. Entrepreneurs delay this asset longer than any other because reinvesting everything back into the business feels more productive. It feels like the entrepreneurial thing to do. And in the early stages, it may be correct, but the entrepreneur who never starts an external investment portfolio has all of their financial risk concentrated in a single illiquid asset they cannot diversify without selling entirely. Start smaller than feels significant. $1,000 in a government-only money market fund, $500 in a REIT. The portfolio size that matters at 50 is built by the habit started at 35. Warren Buffett's $700 million annual Coca-Cola dividend started with a $1.3 billion position entered in 1988. The principle is identical at every scale. Freedom principle. A dividend portfolio does not care whether you worked today. It pays you on the schedule you built, not the hours you keep.
Asset number 4, intellectual property and digital products. A course, a licensed methodology, a digital guide, a proprietary framework, a software tool. Any form of packaged expertise that is created once and sold repeatedly at near zero marginal cost. The economics of intellectual property are unlike any other asset class. A physical product costs the same to produce whether you sell 10 units or 10,000. An online course costs the same to deliver whether it is serving 1 student or 100,000. That asymmetry between fixed creation cost and unlimited scalable revenue is the defining property that makes digital IP one of the most powerful freedom assets available. A course generating $10,000 per month requires the same infrastructure at $10,000 as it does at $100,000. Scaling does not require proportional time investment, which means every additional dollar of digital product revenue is moving your freedom ratio forward without requiring an additional hour of your time. Building the product and calling it an asset before the market has confirmed that anyone will pay for it. Intellectual property has zero value until someone buys it. A course that is never sold is not an asset. It is a well-organized folder on your desktop. Validate before you build. Sell before you create. Find 10 people willing to pay for access to your expertise before investing 6 months building the product. Then build the minimum version. Then sell it. Then improve it. The market tells you what your intellectual property is worth, not your opinion of your own expertise. Freedom principle. Intellectual property converts your expertise into an asset that earns while you sleep, scales without ceiling, and appreciates as your authority grows. We are exactly halfway through. And the next three assets are where most entrepreneurs leave the most freedom on the table. Before we continue, share this video with one entrepreneur who needs to hear this. One share, 5 seconds. It might be the most important thing you do for them today. Now, let's finish this.
Ownership positions in other businesses. As an angel investor, strategic advisor with equity compensation, a revenue share partner, or an early-stage investor that build in value independently of anything you do on a daily basis. Equity appreciation is the most powerful wealth-building mechanism available because it does not require management, does not require trading time, and does not have the same ceiling as earned income. A 5% equity stake in a business that grows from $2 million to $20 million in valuation produces $900,000 in wealth without a single hour of operational involvement after the initial agreement. It diversifies your wealth beyond your own business. It builds net worth that is not correlated to your personal performance, and it creates exit liquidity that is completely independent of your ability to sell your own company at the right time. Taking equity positions based on relationship rather than business fundamentals. Friendly equity that dilutes to nothing through subsequent rounds. Advisory equity in companies with no viable path to exit. Minority positions in businesses where you have no visibility into the decisions that affect your value. Be selective. Take advisory equity only in companies whose business model you understand completely and whose trajectory you believe in based on evidence. Negotiate anti-dilution provisions. Understand the cap table before you sign. One well-chosen equity position is worth 20 poorly chosen ones because one can return everything and the others return nothing. Freedom principle. Equity in other businesses builds wealth you did not have to operate for, the most scalable form of financial freedom available to entrepreneurs.
Financial freedom is not a number. It is a ratio. It is the ratio between your passive income and your living expenses. The moment passive income exceeds living expenses, you are free. Not rich, free. Your time belongs to you. Every asset on this list moves that ratio in your favor. This is the difference between looking wealthy and being wealthy. Drop in the comments, which asset are you building first? Make it public. I will hold you to it. Share this with one entrepreneur who is working hard but not getting free. One share changes the conversation they are having about what they are building. Like, subscribe, and I will see you in the next one.